In this video, I want to talk about the gold market. I didn't trade this yesterday. I want to talk about a setup that I've identified now, this morning, after trading. So what I typically do is I'll go back and look at yesterday's trading for the markets that I did not trade, or even for the markets that I did trade, to try and identify if there's things that I've missed, and this is how I improve my learning of time. Now, while this video is after the effect, right, it's hindsight, I want to make sure you understand that I do trade this market, okay? But I do trade this market, right? This was the day before where I predominantly focused on gold and I had a very good return, okay? So it's not just that I'm talking to you about this after the effect, right? In hindsight, I want to make sure you understand that I do trade this market, okay? So there's my results from just a few days ago on this market, okay? So what we can see, if we take a step back, we can see that we have these pumps, right? So the market's clearly gone up. We can see that we've got a pump up here. That was on Friday, a very choppy day because of the news, but on Monday we have a pump up, right? We're going up in really like a staircase pattern, right? A bit of a zigzag, okay, up these stairs. And you can see now we're kind of right at the top. How do I know that? Well, because if you look to the left, we've taken out the high from Friday and the highs from a couple of days ago last week as well. Now, what really tells you the market stopped going up is this consolidation, right? So we were going up and now we have stopped going up. And in fact, we've started to come down, okay? So I do feel that we're at least headed back down to where this pump has started, okay? So this video is more about yesterday's trading. What do I see in the market yesterday and my analysis on what I missed. So if we look very closely, let's see if it's clearer on a 5-minute chart. Let me come to the 5-minute in a moment. We can see what I have many times pointed out is that prior to the session in New York, so that there is the New York session in that yellow box. Now, prior to that session, what do you see? You see these 3 down candles, 50-minute candles, right? That there is the false move. So when I see that, I immediately know with high probability that we are most likely going to go up, okay? Now, what's important here is I want you to notice what these red lines are, okay? These red lines here on my chart, these are pre-drawn on my chart. They are, that box, if I drew a box there, that represents 100 pips, okay? So if we look at where gold opened in New York, at 8 a.m. in New York, it opened at the low of that 100 pip box. Now, with high probability, you will find resistance at the top of that 100 pip box, okay? So knowing that's important because you can see gold yesterday stayed within its 100 pip box. And if it's going to go above that 100 pip box, then it would basically go through there, come back on top, and then continue, okay? Now, knowing how the market behaves at certain times is also very important because I can take that into account. I know that the gold market typically makes a low or a high for the day at 9:30 a.m. New York time. Okay, that's when the equity market's open. So really at 9:35, if I want to go long gold, I want to go long gold at 9:30, and I really want the market to be at a low. Now, if we look at the on yesterday's trading, that's the 9:30 bar. That's 9:15, but that's the 9:30 bar there. So if we look at yesterday's trading, we can see a couple of things, right? We know that at 9:30, we're basically at the high of that 100 pip box. Okay, and sure, we could still go higher because there's still traders who are shorted from Asia that haven't been taken out, and that's fair. But when we are at the top of a 100 pip box and we're at 9:30, we're basically at the highs. And to me, that kind of indicates we might find some resistance there. Now, you can see that for quite some time, it was chopping around. So you had a lot of time, if we were long that market, from the open of New York, which is a very valid setup because we have very clear 3 50-minute candles going down into the low of the day prior to the open of a session. That is a 45-minute dump for the pump, okay? So that's a very valid setup to long there, especially after the engulfment there. And on a lower time frame, you might be able to get a better entry, okay? And, on gold, I typically only target 50 to 75 pips, which is very easily achievable in yesterday's trading, even though I didn't trade that, okay? Now, I'll also point out that you've got to kind of combine these different things. So when you're up at this level, you've got more than an hour to exit that trade at that 100 pip box resistance level, especially when you see that there's a 9:30 bar, 9:30 to 9:45, we're at the highs. And essentially that is a false break reversal, okay, on a lower time frame. You get a break above that 100 pip top end of the box, and it's a false break, you come back down into the range, and then that's that push up at 9:30 into that resistance level, okay? So just imagine that that red line right there, just imagine that's the high of the week, okay? Because those red lines are key levels. They are key institutional price points, and they are predetermined on my chart. That level there, that red line represents 2320 for the price of gold, okay? So I always consider those as resistance. So in my head, I'm just thinking that's the high of the week, okay? That just makes it easy for me to identify what that level is. And so what we have there, bear with me in my terminology now, we've got a break above the high of the week at a key time, right, around at 9:30, because that bar there started at 9:15, ended at 9:30. Okay, and the next bar, so we get that break above what I'm calling high of the week, resistance level, push back inside the range, and then the 930 bar, which ended at 945, is your pushback into anyone that may have gone short from that wick at 915, that 915 bar that closed at 930, right? So that's the close at 930, that's the close at 945. Okay, so you got to be very nimble in these markets. Okay, you had a very, very clear entry opportunity at the open of New York, 8 a.m. That really isn't the time that I trade gold, but seeing these 15-minute down candles, I would have no hesitation in getting long into that market because that is a clear setup for me. Okay, 3 down candles, 15-minute candles, 45-minute pump down at the low of the day at the start of the New York Open for gold. That's a very clear entry. And noting that it's right at the low of that 100 pip box, and we get a straight pump up into the highs from anyone that's shorted in London. Okay, and what I want you to also notice here, I want you to notice that look for the high bull candle in any market, right? And look for resistance there. So you got a couple, lots of different things. So that is the high bull candle, okay, which started this move down. Okay, I'm going to draw a line there on the chart. There is the high bull candle. I'm putting it right on the open, okay? And look at the bodies of the candles now in gold, okay? So that now starts to open up what you can see, right? So you've got to kind of identify some of these things. You know, an easy way to identify this is when you have a situation where you've got, look at the bodies of these candles. They are horizontally aligned, okay? Something's holding price there. And you want to look to the left of that and try and work out what's going on there. Like, that is so clean, so neat that you can very clearly see that something is holding price there. And if I look to the left, that is the high bull candle. Now, I know that, okay, because of my experience in reading price. For you, that's an eye-opener now. You now have that in your arsenal to use in your toolbox to see that couple of things. Where could my target be? If I am taking a long from the low of the day at the low of a 100 pip box after seeing my 45-minute dump, if I'm taking my long entry there, where could my target be? Well, time's important. So you could definitely say my target's going to be at the highs of the day, but it all comes down to time. If at around that 9:30 time, we are at the high of the 100 pip box, and we see that something seems to be holding price, we look to the left and we have a high bull for the London session, which is basically now going up and stopping at anyone that was short in London, and it's now 9:30. Well, then I want to close out that trade. If I'm holding and I still continue to see all this resistance, I've got plenty of time to exit that trade. Look at how many opportunities I've had. We've got, let's count them, 15-minute bars. We have one 15-minute bar, a second 15-minute bar, a third 15-minute bar, a fourth 15-minute bar. That's 1 hour. And then another 15-minute bar after that, another one after that, another one after that. So now we're 45 minutes sitting there, giving us the opportunity to exit our position. Okay, so whenever the market stops somewhere, you need to look to the left and try and work out why has it stopped there. Is this a potential exit? Should I be closing my position? Should I be taking off half? You can take off half or 60% or 80% of your position and leave the rest for a run up for a potential move up to the highs that you may be expecting. Okay, but at 9:30, 9:45, or even 10 a.m., they are key turning points. And you want to kind of look at the market and try and work out, is this going to be a key turning point? Not just on time, but what is price doing? Is there what's on the left here? Why is price held here? What's going on? Well, there's a high bull in London. It's 9:30, 9:45. It's getting close to 10 a.m. This is the turning point. Should I be closing out? I'm already up 75 to 100 pips. Okay, so I hope that was useful. You always got to go back and look at these charts. Now, I didn't take this opportunity. This is an opportunity that I've missed, but I've gone back and I've looked at this and I've identified that I've missed this opportunity. And so this adds to my learning experience and helps me reinforce that these patterns do in fact work. And so this puts a visual picture in my head of how I would have traded this by walking through what I see here after the effect in hindsight. Okay, so I will now talk with you in a future video.